So, hello everybody. I am making this video as a review of some of the chapters in Burke and DiMarzo, and this is chapter 2, and I will create videos as we go along. You're going to have to review many of these earlier chapters because a lot of the items we are going to cover, the material we will cover, will be a function of the previous material. So luckily you'll have the whole book, so you'll be able to go back. But let me just say this. Let's look at financial statements rather quickly here. And basically, they're filed with the Securities and Exchange Commission. And it gives us information on the past performance of the company. And these are filed quarterly, 10Q, which stands for quarterly, and 10K, which is an annual statement. And also, the annual report will go to the financial statements to the shareholders when you send all the information, including the report, the stockholders report, that letter up front. All these statements have to be prepared according to General Accepted Accounting Principles, otherwise known as GAAP, and they must be audited by an auditing company, which is a neutral or third party. All right, so there's a couple different types of financial statements. And this is a little different than you might see in other books, but we know there's a balance sheet, which we all know about, and an income statement. And there's a statement of cash flows. And many times they take the statement of stockholders' equity, and that's included in the balance sheet. So what's missing here, which you might see sometimes, is called a statement of retained earnings. And these are the dividends that were not paid out to the shareholders, and it was kept by the company. For instance, Google does not pay dividends, as you know, or may not know, and the dividends are kept as cash for the company to grow. So, just wanted to make that point. Okay, so the balance sheet, as we said, gives us a snapshot of the financial position of the company, and by now everyone should know that assets should equal liabilities plus stockholders' equity, and they should be balanced. And let me draw a line here. So if I put a line here, it looks something like that, right? Assets are on the left, and liabilities are usually on top here. And stockholders' equity, let me see if I can get another line here, get an arrow, and stockholders' equity is usually somewhere down below these, right? So you should have, you're probably aware of that already. All right, so I just wanted you to know that, and it's good information. All right, so assets are what the company owns, right? There could be short-term and long-term physical assets and cash and marketable securities and inventory. And liabilities, what the company owes. And remember, accounts receivable is up here, and accounts payable will be down here, what the company has to pay out. And the stockholders' equity is a difference between the value of the firm's assets and liabilities. And that's normally on the right-hand side, as I said, on the lower right-hand side under liabilities. All right, so current assets are short-term assets, cash, and other things that are expected to be turned into cash in the current year. And you can see they're all listed here. Okay, so a lot of times you'll see ratios with these numbers, and there'll be something called the current ratio. And sometimes you should be aware that having a large amount of current assets is probably not that great a thing, and we'll talk about that later. Oh, that shouldn't be an arrow, right? We should do that a line now. All right, so anyway, so these make up the current assets in the balance sheet. These are the short-term. Inventory can have 3 components: raw materials, products in production, and finished products. So and then, of course, there's the long-term assets, which you should all be aware of, and that's the net property, plant and equipment, depreciation, which is a non-cash charge, and that gets accumulated. And the book value of the assets is what you paid for it, right? Acquisition cost minus how much it's been depreciated over the years. And I think you may have been in a class where they talked about MACRS, Modified Accelerated Cost Recovery System. All right, and then there's goodwill and intangible, right? Goodwill and intangible means you have non-physical items. Goodwill is a name you may have for itself. So let's, for instance, goodwill would be something like the name Coca-Cola, right? It's got goodwill and is money attached to that. And just even like the name Microsoft, you know, most people don't hesitate to buy Microsoft. The name has a goodwill. And intangible assets could be patents and copyrights and that type of stuff. And you could also have investments in long-term securities, right? Other long-term assets. You could basically be invested in another company. So here's an example of a balance sheet. And as I said, here's the assets and the long-term assets on the left. And so I'll draw a line like this, right? All right, so here's the long-term assets. Here's the short assets on the left. And if I draw a line here, I have the total current or short-term assets. Here's the long-term assets, and here's the total, right, of both assets. Here's the current liabilities, which is the short-term liabilities, and I'll draw a line like that. And here is the long-term liabilities down here. And here's your total liabilities, which is the sum of the two. And then we have the stockholders' equity here, which usually has more items, right? Paid in cash in excess of par and common and preferred. And this gives you the total of everything. And you'll notice over here on the left and on the right, they agree. All right, so I just wanted to make you aware of that. I won't make these videos more than 15 minutes or so because they have a problem to upload, and it'll be a headache. They get quite large. All right, so the liabilities, you have the current liabilities, which again are the short-term liabilities, and accounts payable, and the short-term notes or the short-term debt, current maturities of long-term debt, and other current liabilities, taxes and wages payable. So these are all of the current liabilities or the short-term. All right, now the term net working capital will come up many times, and net working capital is equal to current assets minus current liabilities here. So this is a important equation. Just when you hear net working capital, you should kind of know what it means. This is not a negative. This is simply current assets minus current liabilities. So just be aware of that. Sometimes you'll see change in net working capital with a delta, and there'll be a delta here. So it'll be the change in each from year to year. Here's the long-term liabilities, long-term debt. Maybe you got some capital leases and some deferred taxes that you haven't paid. All right, so here's a balance sheet for, here's the liability side here, right? For 2 years. And you'll notice the current liabilities are here, total current, total long-term liabilities here. Right there, right, 107.5, and here's when you add them up, and here's the stockholders' equity, and this gives us the total. All right, so the stockholders' equity in that balance sheet on the lower right is the book value of equity, and that's simply the book value of the assets minus the book value of the liabilities, and this is basically what they're worth if you take the difference between these two. And this could be negative. All right, so what's market value versus book value? So the market value of equity is you'll see this term many times, right? if you read the papers or if you go up on finance on the internet, and it'll say market cap, and that's simply the market price per share times the number of shares outstanding. And this cannot be negative, and this differs substantially from book value. Many times the book value will also be listed as the value of the stock when you originally purchased it. All right, so here's one of the ratios which you've probably seen in some class, and this is the market to book ratio, and it's the market value of equity to the book value of equity. And there's a good need for that, right? And this is also called the price to book ratio. And value stocks, you'll have low market to book ratios because basically they basically may pay a good dividend, right? And then there's growth stocks which have a high market to book ratio. An example of growth stocks would be something like Amazon.com, right? That stock has been shooting up, or Google, right? So so value stocks are stuff like maybe like GE, and where they pay a dividend, or AT&T, or Verizon. All right, so this term is important, and if you haven't ever seen it, you should go to Chapter 2 and read what this is. The enterprise value, otherwise known as the total enterprise value, TEV, is equal to the current market value of equity plus the amount of debt you have minus the cash you currently have. You subtract off the cash, that's not included in your enterprise value. And let me look into the book here, and I will tell you in a minute where you should be looking at. So if you're on page 30, I'm looking at page 30, and that's basically the enterprise value, and it's equation 2.4. So this is equation 2.4, and this is the value of the underlying business assets. Okay, so just want to make that clear to everybody. This would basically be the cost to take over the business if someone was going to buy the business. So you wouldn't include the cash you have. All right, so here's an example. Market versus book value. If Global has 3.6 million shares outstanding, and those shares are traded for $14 per share, what is Global's market capitalization? And the answer to that is quite simple. And that's on page 29 in your book. And if I simply multiply this together, I get 50.4 million. I multiply these two numbers, and this market capitalization is significantly higher than Global's book value of 22.2 million. Thus, investors are willing to pay 2.27 times the amount of Global shares according to their book value. So these shares are trading at 2.27 times the original book value. All right, so here's another example. This is an alternative example, and feel free to go over this. If you have any questions, always feel free to email me. So here's the solution. Here was the market cap, and here's the market to book ratio, and it's trading at 10.8 times its book value. All right, so I'll stop here, and maybe I'll make another video later to pick up on the income statement, because I'm 14 minutes into this one. As I said, they're quite large, and it takes me quite a while to upload them. And it's easier for you to just watch them in snippets, I believe. Alrighty. See everybody tomorrow. So